Hi there, welcome to this presentation about passive investing. My name is Juan Francisco Rodriguez, and together with Juan Manuel Rodriguez, I know it sounds funny, we should call the company Rodriguez and Rodriguez. Anyway, we are the founding members of Impassive Wealth Limited. So let me get started and tell you what impassive investing is all about. Right, let's start with some essential concepts. First of all, the impassive method of investing is inspired by passive investing, but it's been refined. So the rebalancing of assets, the classic rebalancing on passive investing, has been improved. It is more frequent. Typically in passive investing, you do rebalancing once a year, and we do rebalancing every month, and it's more sophisticated. We have created an algorithm that tells us every month what to buy and sell to do this rebalancing. Okay, basic rules we have are the following. Funds are only partly invested. Another part of the funds is reserved as liquidity to be able to, buy more assets should prices evolve, and it is advisable to buy. And the periodic check, normally every month, leads to buy or sell orders, right? And that is entirely mandated by a set of mathematical rules organized as an algorithm. It is entirely price-based, so we only use the prices to make those buy or sell decisions, right? And basic rule is to buy cheap and sell expensive, so as to make money and obtain decent returns, right? So these are the differences with, both active and passive investing that we have incorporated into impassive investing. Okay, what are the advantages we see on this method? Well, there are many, as we will see in a second. This method is very versatile. Okay, so it can be applied to many different assets. Basically, anything that is traded in an organized market can be used with this method, right? It is defensive. It is very good at preserving capital. One of the reasons is we don't invest 100% of the fund, so the part that is liquidity is not risked, and so in a downturn, our capital is preserved better than if we had invested 100% of the money. Satisfactory in the sense that it can provide with little risk returns that are suitable to most investors. Perhaps twice the rate of inflation, or even a bit more. Most people should be satisfied with that. It is a valuable method in the sense of value. I mentioned already, buy low, sell high, and you'll make money. So the algorithm is designed to do this automatically. It is low risk because liquidity is stored in safe assets. So, we are not risking the liquidity. The liquidity is a tool for the system. But still you can get small return from, in liquid assets. It is very simple. Orders once a month, if there are any. Most months there are no orders, so there's nothing to do. But worst case, orders need to be carried out once a month. Okay, it is impassive, and this is a bit of a recursive definition. It is impassive because you have to be detached from the daily noise of ups and downs, all the media, all the hype about, what's going on in the markets, all that, which is very confusing to most investors. It's historic in the sense that we use prices. We don't make predictions. So, it's based on the past, not in the future. It is very difficult, if not impossible, to predict the future. So, we prefer to base our decisions on what has happened already. Let's take a look at two examples. One example, as I said, this can be used with any asset. So we picked the shares of the Santander Bank, a Spanish multinational bank, from December 1998 to May 2016. So what happened there? Well, you get paltry 1.8% annualized return. So the shares have been trading flat for all this time, right? Up and down, lots of volatility, but at the end of the day, from beginning to end, 100 to 136, 36% in a lot of years. Annualized 1.8%. So what happens if we apply the algorithm to the Santander shares and do this, buying and selling once a month? Well, we turn 1.8% into 6.1%, okay? And so, in a sideways market or with shares that go nowhere, you can still make money using impassive investing, right? Lesson number one. In the second example, we have what we call the Impassive Wealth Classic portfolio. Okay, so not a single share as before, but a portfolio of different assets this time. So how do you do your asset allocation? Well, first thing is we buy the whole market, because you don't know which asset class is going to do well or do bad. You just buy anything that is worth investing in, right? And of course we reserve a good chunk of the funds as liquidity. The algorithm manages the liquidity and the assets, buying and selling, according to the unequivocal results provided by the algorithm. Now, when we say buy the whole market, we are looking for diversification, meaning buy different types of assets, so not to have all the eggs in one basket. Diversification is performed mainly, the main asset we use is shares, because they have the best returns of all asset classes. So in shares we do a diversification by region. So we consider Europe, the USA, emerging markets, and Asia Pacific, right? And we do a diversification by size. So we put a little bit of small caps together with the usual big caps. Now, we do this by using indexes, passive instruments that simply track stock market indexes. In this example, we'll see afterwards, we have used investment mutual funds from Vanguard, which are very, very cheap. We are looking for decorrelation, meaning add other assets that evolve in a different way as equities. So to have a bit of a mix, when something goes up, something else goes down, we increase the liquidity in one of the assets, we decrease it in another one, so the result is nicer, smoother, over time. These other assets are real estate, rates, gold, and commodities. There might be others, and the idea is to get different evolutions, right, that in the long term will provide a smooth, nice return. So the strategy is long term, it's low cost. That's why the Vanguard instruments are ideal, because they are ultra cheap. Okay, and we are always invested, only we are not invested at 100%, as many people would do. Right, so let's have a look at real data. This portfolio in US dollars has been made with Vanguard tracking funds. Okay, and so from 86 to 2016, that is 30 years. Okay, so the Vanguard funds investing in shares, in share indexes, have provided a 9.5 annualized percentage of return. Okay, which is pretty good as an average, beating inflation clearly. The Vanguard fund used for short-term debt, that is the fund used for the liquidity, okay, has provided in this period, I know now it would be very difficult to find this return, but in this 30-year period, as an annualized average, has provided 5.2%. Okay. Now, a strategy of buy, hold, and rebalance with all the Vanguard funds for shares and the Vanguard fund for the liquidity, meaning once a year you return your asset classes to their original percentage, right? Once a year, normally on your birthday, so you don't forget it, would provide 7.7%. Okay, right? Which is a nice return. Now, Impassive Wealth Classic in US dollars would return 9%, okay, which is great. We only lose half a percentage point, which is substantial but not huge, you know. But, you know, look at the dotted line there. Those are liquid assets. We are not risking those. Compared to somebody, you know, being invested 100%, the light gray area, yeah, you get 9.5 compared to 9, but, you know, you are risking your money quite a lot more, right? So less risk, a small, little less return, but, you know, I think on balance, you know, you get a good return and you are invested on average just 54%, right? So that is, you know, the whole point of the Impassive Wealth Classic portfolio. And just to finish, you know, let's take a look at the evolution of liquidity in green, you know, due to the dynamic rebalancing. So in October 2007, you know, 52%, the green portion of the pie is, you know, in liquid assets, right? Here comes 2008, 2009, you know, the crashes on the stock markets. And you can see we've been buying equities and decreasing liquidity quite substantially to 22%. In June 2009, you know, we reached a 7% liquidity, but this means that we have bought a lot of cheap shares all over the world, right? Because, you know, after the financial crisis and the panic, you know, everybody was selling and prices went down. But these were still good assets. So buying them at that point makes a lot of sense. Now, when the market recovers, and we are now in April 2016, liquidity is at 44%, meaning all the way up from 2009, we've been selling those cheap shares and making money out of them. Okay, just detailed an optimization that you can make when you have a portfolio as opposed to a single asset. The liquidity is assigned to each of the assets, but you can't spend all the liquidity for a particular asset, right? And that is tragic because, you know, if prices still go down, you cannot buy more cheaper shares on the way down, right? This possibility of running out of liquidity has to be minimized to get all the power of the Impassive algorithm. And the way of minimizing the possibility of running out of liquidity is with diversification, because, you know, different markets will evolve in different ways, and some will spend more liquidity or faster than others. So you'll get liquidity in other assets, and mainly the decorrelation. For instance, in gold, when the stock market goes well, gold tanks basically, and the other way around. When gold rises, the stock markets are in difficulty. So gold is a bit of a tool, generating that liquidity at the time when you need it, and still making money in panics when gold, rises in price. So we borrow liquidity from other asset classes just to keep the machine going. So this is it. These are the basics of the impassive system of investing. Thank you very much. Get in touch if you have any questions. See you soon.